Welcome to the deep dive. Today, we're going to be diving into the world of Indian finance, looking at Equitas Small Finance Bank's Q3 2024 performance. Fresh from their January 2025 report, we'll unpack, their recent moves, break down some of the key numbers, and see if their actions, really live up to their slogan of beyond banking.
It's definitely an interesting case study, especially given their, unique position in the Indian banking landscape.
Right. The report highlights that Equitas is classified as a small finance bank, which immediately piqued my interest. And then there's this intriguing detail about them issuing 500 crore rupees, that's about 61 million US dollars, in unsecured non-convertible debentures or NCDs back in December.
Yeah.
What's the deal with that?
Let's break those down. First, the small finance bank designation means Equitas operates differently than traditional commercial banks. They're specifically focused on serving segments of the population that are often overlooked by larger institutions. Think small businesses, micro-entrepreneurs, farmers, and individuals in rural or semi-urban areas.
So they're filling a crucial gap in the market, providing access to financial services that might not be readily available otherwise. That's a compelling angle, but it also makes me wonder about those unsecured NCDs. What prompted them to go that route?
NCDs are essentially loans that the bank takes from investors. And the unsecured part means they aren't backed by specific assets of the bank. This makes them riskier for investors, but can also offer them a higher potential return. For Equitas, issuing unsecured NCDs could signal several things. They might be looking to fuel rapid expansion, perhaps to reach even more customers in their target market. Or they could be investing in new technologies or infrastructure to improve their services. However, it also raises the question of whether this move aligns with their social mission.
Their slogan, Beyond Banking, when you bank with us, you contribute towards a better society, definitely sets a high bar. It implies a commitment to social impact that goes beyond just making a profit. But does issuing potentially risky unsecured debt really align with that?
It's a valid question. On the one hand, you could argue that by expanding their reach and investing in their operations, they're ultimately enabling more people to access financial services, which can have a positive social impact. But on the other hand, taking on more risk could potentially jeopardize their financial stability, and that could have negative repercussions for the very communities they aim to serve.
So it's a bit of a tightrope walk. They're trying to balance growth and financial stability while also living up to their social mission. Let's see if their Q3 performance sheds some light on how they're managing this balancing act. One thing that jumped out at me was their net profit for the quarter. They posted a profit of 6.63 crore rupees, which is roughly 800,000 US dollars.
That's significant because it represents a sharp turnaround from the previous quarter, where they actually reported a loss. This suggests they've been able to address some of the challenges they were facing and regain their footing.
That's a positive sign. But their year-to-date profit tells a different story. It's significantly down compared to the same period last year. They've only earned 10.49 crore rupees so far this year, a big drop from the 79.49 crore rupees they earned during the same period last year.
This discrepancy raises some important questions. What factors contributed to this year-over-year decline? Is it due to, internal challenges within the bank, or are there broader economic headwinds at play?
We'll need to dig deeper into the report to get a clearer picture. And speaking of digging deeper, their earnings per share or EPS numbers caught my eye. Both their basic and diluted EPS are up year over year, but they're down compared to the previous quarter. That seems like a mixed bag for investors.
It is. While the year-over-year increase is generally a positive sign, indicating that the bank is becoming more profitable on a per-share basis, the quarter-over-quarter decline might raise some eyebrows. Yeah, it might make some investors kind of scratch their heads a bit.
So investors will be watching closely to see if this recent dip is a temporary blip or a sign of something more concerning. To really understand these fluctuations, I think we need to delve into some of the underlying factors driving their profitability, including their operating expenses and potentially the broader economic climate in India.
Agreed. Let's look at, the components of their profitability. One key metric is their net interest income. That's the difference between what they earn on loans and what they pay on deposits. The report shows this has been relatively stable. However, their operating expenses, particularly employee costs, have increased.
So while they're not losing money on their core lending activities, they're spending more to keep the engine running. Could this be tied to their growth strategy? Maybe those rising employee costs reflect investments in talent to support their expansion efforts, like reaching those underserved communities we talked about earlier?
That's certainly a plausible explanation. Expanding into new markets or offering new products and services often requires, additional personnel. And remember, their Beyond Banking tagline suggests they're not just focused on traditional banking services. Perhaps they're investing in staff with expertise in microfinance, community development, or financial literacy to support their social mission.
That's a great point. It connects those rising costs to their broader goals. But what about that significant year-over-year profit decline? Could that be linked to the overall economic climate in India?
Absolutely. We can't ignore the macroeconomic context. India's economic growth has slowed recently, and this can trickle down to the financial sector. Small businesses, a core customer base for Equitas, might be facing challenges, which could translate into slower loan growth or even an increase in defaults for the bank.
That makes a lot of sense. It adds another layer to their balancing act, managing internal factors like expenses while navigating external pressures like a slowing economy. Now, before we move on, let's circle back to those EPS numbers. The fact that both basic and diluted EPS are up year over year but down compared to the last quarter is still a bit perplexing.
Think of it this way. The year-over-year increase suggests the bank is becoming more profitable per share overall, but the quarter-over-quarter decline could signal some caution. Imagine you're an investor, right, looking at Equitas. That recent dip might make you wonder if the Q3 profit jump was just a one-time event or if the bank can sustain that momentum going forward. And the fact that diluted EPS is down could amplify those concerns.
Okay, I'm starting to see why investors might be feeling a bit cautious. Diluted EPS takes into account things like stock options, which can increase the number of shares outstanding, potentially diluting the earnings per share.
Exactly. So even though the bank's overall profit might be growing, if the number of shares outstanding is also increasing rapidly, it can impact the earnings attributed to each individual share.
All right, so we've got a better grasp on the profit picture and those intriguing EPS trends. Now, I will shift gears and delve into some other key metrics that stood out to me in the report, particularly those that might shed light on the bank's overall financial health and risk profile.
Sounds good. What caught your eye?
Well, first, their gross NPA ratio, which measures the percentage of loans that have gone bad, stands at 2.97%. That's a slight uptick from last year. Should we be reading into this?
NPAs, or non-performing assets, are essentially loans that are no longer generating income for the bank, either because the borrower isn't making payments or the loan has been written off. It's a crucial indicator of a bank's asset quality and overall health. A rising NPA ratio, like the one we see with Equitas, can suggest that more of their loans are at risk of default.
And remember, they're a small finance bank, catering to a customer base that might be considered riskier than those of traditional commercial banks.
Precisely. Small businesses and individuals in underserved areas often face greater economic vulnerability and might have less robust credit histories compared to larger, more established businesses. So while a rising NPA ratio isn't necessarily a cause for panic, it does warrant attention.
It reinforces the need to consider the broader context of their lending practices and the types of customers they serve.
Right. Part of that delicate balance we discussed earlier, trying to promote financial inclusion and serve those who might not otherwise have access to credit, while also managing the inherent risks associated with that approach.
Okay, so we've got NPAs on our radar. Now for a potentially brighter spot, their debt-to-equity ratio has decreased significantly since last year, coming in at 0.26. What's the significance of that?
The debt-to-equity ratio tells us how much a company relies on borrowed funds, debt, compared to its own funds, equity, to finance its assets. Think of it like building a house. You could either use your own savings, equity, or take out a mortgage debt. A lower debt-to-equity ratio generally indicates a stronger financial position because the company is less reliant on borrowed money.
So in Equitas's case, this lower ratio suggests they've been actively reducing their reliance on debt, which could be seen as a positive move towards greater financial stability, right?
Exactly. It could indicate that they're managing their finances prudently, trying to reduce their risk exposure, and potentially building a more solid foundation for future growth. However, it's worth noting that there's no one-size-fits-all ideal debt-to-equity ratio. It varies depending on industry, growth stage, and a company's specific circumstances.
It's all about context, as always. And that brings us back to the overarching question of their social mission. They're clearly making financial moves, issuing NCDs, managing expenses, navigating NPAs. But how does all of this connect to their stated goal of contributing to a better society?
That's the million-dollar question, isn't it? We've been analyzing the numbers, but now we need to examine how those numbers translate into real-world impact.
Let's shift our focus to that next. We've covered a lot of ground analyzing Equitas, small finance banks, recent performance, their strategic decisions, and their overall financial health. But now let's bring it back to their mission, that intriguing tagline, beyond banking. When you bank with us, you contribute towards a better society. How do we assess whether they're living up to that?
It's a complex question, and it requires us to look beyond the numbers and consider the, real-world impact of their actions. On one hand, their focus on financial inclusion, serving those often excluded from traditional banking, inherently carries a positive social potential.
Just by providing access to credit, savings accounts, and other financial services to these underserved communities, they're enabling economic participation and potentially empowering individuals and small businesses.
Exactly. Think of a small entrepreneur in a rural village who, thanks to a loan from Equitas, is able to start a business, create jobs, and contribute to the local economy. That's a tangible example of their social impact.
It brings that beyond banking idea to life. But as we discussed earlier, there's also a potential downside to consider.
Right. The risk of over-indebtedness among vulnerable populations is a valid concern. If lending practices aren't managed responsibly, it can lead to a cycle of debt that can actually harm the very communities they aim to serve.
That's a crucial point. It highlights the importance of not just focusing on access to credit, but also on ensuring responsible lending practices, financial literacy, and support for borrowers.
Absolutely. We need to look at the details. What are the interest rates Equitas is charging on its loans? Are they providing clear and transparent information to borrowers? Are they offering financial education programs to help people make informed decisions? These factors all contribute to a more holistic picture of their social impact.
It shifts the focus from are they lending to how are they lending?
Precisely. And that's where transparency and public accountability become essential. Ideally, we'd want to see Equitas proactively reporting on its social impact initiatives, measuring outcomes, and being open about both the positive and potentially negative consequences of its operations.
So ultimately, it's about going beyond the slogan and examining the concrete actions and their demonstrable effects on individuals, communities, and the broader society.
Exactly. It's about assessing their commitment to responsible financial inclusion.
This has been an incredibly insightful deep dive. To sum it up for our listener, we've seen that Equitas Small Finance Bank is a company navigating a period of change. They're rebounding from a recent dip in profitability, taking calculated risks to fuel growth, and striving to maintain a balance between financial stability and their social mission.
The performance this quarter, particularly the issuance of those unsecured NCDs, raises important questions about their long-term strategy and whether it will truly benefit the communities they aim to serve.
And it reminds us that financial performance is only one piece of the puzzle. We encourage you to dig deeper, explore the details of their lending practices, and consider the broader impact of their actions on the Indian financial landscape and society as a whole.
Remember, knowledge is power, and informed decision-making is crucial, especially when it comes to understanding the complex interplay between finance and social impact.
Well said. That wraps up our deep dive into Equitas Small Finance Bank. Thanks for joining us.